Welcome to today's Explainer. We're diving right into the current technical posture of the broader financial markets to figure out, well, exactly where we're heading next. If you've been watching the tickers, you know the action has been relentless. We've seen record highs, swift pullbacks, and just a whole lot of noise out there in the financial media. But if you look beneath that daily noise, the actual price action, the undeniable footprint of institutional money, is starting to tell a much deeper, more suspenseful story. It's a story of exhaustion, compression, and a looming decision point that could absolutely dictate the rest of the trading year.
So let's cut right to the central mystery on every active investor's mind right now. Is the massive, seemingly unstoppable upward momentum we've had recently finally running out of steam? Or is the market just taking a breather? It's your classic bull versus bear debate. And to answer it, we can't just rely on today's headlines or gut feelings. We've got to read the tape. We need to see what historical price action is signaling right this second, because as we know, the market has this fascinating habit of leaving clues right before it makes a massive move.
Let's zoom out and take a wide lens, multi-year view of both the SPY and the tech-heavy QQQ. When you look at them side by side, this massive, synchronized trajectory just jumps right out at you. Since the extreme volatility and crazy rallies of 2021, both the broader market and the tech sector have been riding incredibly similar waves. Just look at that rhythmic ebb and flow. You get those deep, gut-wrenching pullbacks that shake out the weak hands, followed instantly by aggressive, resilient rallies to dizzying new heights. It's essentially a visual representation of market psychology over the last half-decade, a constant tug-of-war between fear and greed that, honestly, has skewed heavily toward the bulls so far. Now, focusing purely on the SPY for a second, I really wanted you to notice the historical peaks marked by those yellow circles. These aren't just random data points. They are major macroeconomic battlegrounds. You can clearly see the dramatic top in late 2021, right before the brutal 2022 bear market wiped out trillions in wealth, and then that formidable peak in early 2025. These were moments where the market pushed to its absolute limits, fueled by pure euphoria, only to get violently rejected by sellers who decided enough was enough. These circles literally represent the exact altitude where the air simply got too thin for the bulls to keep breathing. And get this, the tech sector tells the exact same story. The QQQ mirrors those historical peaks perfectly, leading us right up to that third yellow circle, which is our current position as of mid-July 2026. Tech hasn't just been following the broader market, it's been walking in lockstep, hitting its head on the exact same macroeconomic ceilings at the exact same times. When you think about the fact that the NASDAQ 100 is driven by completely different fundamental catalysts than the broader S&P 500, like the AI boom and massive semiconductor demand, it's pretty wild to see their long-term technical charts looking like carbon copies. It really proves that macro forces are just totally overriding individual sector stories right now. So here's the absolutely crucial takeaway. Those yellow circles represent immense psychological and technical barriers. But as market history proves time and time again, what was once a seemingly impenetrable ceiling eventually becomes the foundational floor for the next leg up. Think of it like a jet breaking the sound barrier. It shakes violently right before it pushes through, but once it does, smooth sailing. Once buyers finally chew through that historical supply of sellers at a certain price point, that old resistance level becomes a launch pad. But, as you know, breaking through that ceiling is never a smooth ride. It requires a tremendous amount of capital and absolute conviction.
But to truly gauge our current position, we've got to pivot. We need to shift our focus from that sweeping, multi-year momentum down to the grounded, gritty reality of the present. Short-term, sideways consolidation. We have to reconcile the massive macro uptrend with the micro reality that, for the moment anyway, the market has completely stalled. It's kind of like watching a race car that was just flying at 200 miles an hour down the straightaway suddenly get stuck behind a pace car. The engine is revving, the potential energy is totally there, but the forward progress has been completely halted.
Now, looking at the daily time frame for the SPY, the narrative really shifts. Check out the price action since early June. The market is acting exactly like a runner taking a heavy, exhausted breath after a massive sprint. It is trapped in a clearly defined holding pattern. All of that aggressive, earlier upward volatility has suddenly compressed into this tight, sideways channel. The market is essentially trying to digest those massive gains it just made. It's asking itself, are we too expensive right now, or is this just the new normal? And until it answers that question, we are stuck moving right instead of up or down.
You can clearly see the parameters of this squeeze outlined by the yellow dotted lines here. The SPY is currently trapped in a rigid box. We've got a solid ceiling of resistance near 760, and every single time the price touches that line, sellers swat it right back down. On the flip side, there's a highly reliable floor near 720 where buyers consistently swoop in, scooping up what they perceive as a discount. So right now, hovering near 743, the market is sitting squarely in no man's land. It's comfortably in the middle, avoiding the edges, just desperately waiting for a fundamental catalyst, maybe a massive earnings blowout or a big economic data print to finally break the stalemate.
Over in the tech sector, though, we're facing an even more intense setup. The QQQ is experiencing an almost identical but significantly tighter short-term squeeze. The daily swings are compressing rapidly. Instead of wide, volatile trading days, we're seeing the candles get smaller and smaller. And let me tell you, when volatility drops this drastically in a high beta sector like tech, it is a massive flashing red light that a huge move is brewing right beneath the surface. It is the classic calm before the storm. The tech giants are locked in a standoff, and the longer this staring contest goes on, the more violent the reaction's going to be when someone finally blinks. Take a close look at the tech battleground defined here. There is a clear ceiling at $750, but look at the floor. It sits just below $690. Unlike the broader market, which is resting comfortably in the middle of its range, the QQQ is pressing dangerously close to the very bottom of its support channel at $695. It is heavily testing the buyer's resolve. Every single time the price flirts with that lower boundary, it's basically daring the bulls to step up and defend their territory. If they fail and that line breaks, things could get incredibly ugly for tech portfolios very quickly. It's a high-stakes game of chicken.
When we look at these daily charts side by side, it is so obvious that both indices are currently testing the middle to bottom limits of their respective consolidation channels. And here's the thing, when markets trade sideways like this for weeks on end, they build immense pressure, much like winding up a coiled spring. The tension just keeps building. The longer they chop sideways, frustrating the bulls trying to buy the breakout and the bears trying to short the breakdown, the more explosive the eventual resolution will be. All that trapped capital on both sides of the trade gets unleashed at once when a boundary finally gives way, causing a massive domino effect of forced buying or forced selling.
So the ultimate question we're left with as we watch this unfold is massive. Will this built-up pressure trigger an explosive breakout to new all-time highs or a devastating breakdown below support? If those lower boundaries fail, especially on the highly vulnerable tech-heavy QQQ, that multi-year macro uptrend is in for a severe stress test. We could literally see a cascade of selling that reshapes the entire second half of the year. So, are we looking at the launch pad for the next great bull run or the trapdoor for a broader market correction? Keep your eyes strictly on those dotted lines. They're about to tell us everything.